So, welcome back to the Brutally Honest Loan Officer podcast. I am Stephen Brock with the mortgage firm and always have my wonderful sidekick. You're a sidekick this episode, Mr.
I'm the
Derick Brown.
sidekick.
This
Maybe this
episode,
episode.
yeah, you're Robin on this episode.
Oh, you're Batman?
We've
Wow.
never been seen
Wow.
in the same room. I'm just saying. I could be.
Okay.
Could
Okay.
be.
I'll be your Robin today.
Oh, I can't wait till next week what I turn into on you. But
I don't know. We'll have to wait and see.
so
What's up, buddy?
how are things with you, man?
Great. Um, just another busy weekend, dude. Like, I don't know why we do it to ourselves. My wife and I just don't slow down. I don't know. We went to a friend's house to watch the air show that was near us, stayed almost a whole day, then had dinner there, then came home. Then the next day we decided instead of just relaxing by the pool, we're going to go to Epcot for the first half of the day, had lunch there, then came home for nap time. Kids took a good nap, and then we went over to a friend's house for dinner. Just action packed.
It always
So then, like, we're at night kind of scrambling, like, we got to do some laundry. We got to clean this. Like, I don't know. We do it to ourselves.
like I
But
say, maybe because you live. I mean, there have been times where my wife's at like 9 o'clock at night. It's like, let's go to Disney tomorrow. Right? All right, let's do that. You,
yeah,
you're right there, so I mean, you can really do it. But we're 2 hours away, but still, we'll just go up there. Sometimes drive back.
right.
Screw it, but
Because we live so close, it makes sense to go for half a day.
yeah,
And we've got the passes. Normally, we don't eat there.
because it's super
So,
expensive. All right, so let's get on our topic. Well, I'll say my weekend. My kids are in full sports mode. So we had one volleyball game, two soccer games. They go to our friend's house by the pool. At least the soccer games were back to back, so I'm just sitting out in the sun for 2.5 hours straight.
did you put on sunscreen?
I did,
Good
and my
job.
son do. My daughter doesn't need it. My daughter is Italian, so
That's probably inaccurate there, Stephen.
she's half Italian.
She may not burn the way you do, but like
So I'll put it
sunscreen
this
is
way:
still good. It
she
helps
gets
protect her
it.
skin.
She gets
Italian people can
sunscreen,
still get skin cancer,
but I'll say
Stephen.
this with her: she thinks about the sun, she turns tan. Just thinks about it. Me and my son, we think about the sun, we turn red.
Yeah.
We
Dude,
don't
I
even
think it's
have to
so
go
funny the
outside.
way like
I can think about like I'm gonna go by the pool and my skin starts turning red.
wow.
Just kind
I
of
don't know. So is your daughter like your wife
mhm.
and your son's like you?
Yep.
Bro, I'm the same. Audrey is a straight up twin of my wife. But she could spend 30 minutes out in the sun and she is bronzed goddess. Like what? And she holds a tan for forever.
Yeah.
Like around Christmas time, like I noticed she still had tan lines and we hadn't been to the beach in months. So I don't know. And then our son Bennett, he's translucent. Like he is a white boy.
Yeah.
Just oh man, but he's the cutest thing in the world. And he knows it. He's been naughty lately.
The puppy dog guys afterwards, so you get away with it.
Oh yeah. Oh yeah. And he'll know he's being bad, and then he does like the little side eye, like, oh God, dude. It's so funny.
Just testing
And
them.
he's not, yeah, he's just a little naughty boy.
It happens. But
But I
so
think it's
let's
so funny the way we like our kids are, the same. Like my daughter is my wife's twin, and my son looks like me. I don't know.
well, both of them look like me, but I can never deny them. But my daughter definitely takes after my wife and my
Gotcha.
son. When like my dad comes into town, it's three generations of that my wife has to deal with, and she's like, "Oh my God, I see where you get it from on anything."
It's pretty
She's like,
cool though, because your son can just see what he's gonna look like in the future.
"Yep, we'll have all our hair. It'll just go gray, probably in our
Oh
40s."
man, I'm so jealous. Look at this island I got coming in. It's terrible. I
Geez,
need
but
to do the implant thing or whatever. I don't know.
there you go. Don't do that. But all right, let's dive into our topic. People are tired of
What
hearing
is our
about it.
topic, Steven?
The great and wonderful condo world.
Condominiums.
Let's go over condo. And I want to say with the condos is a lot of people think it's a type of building, which technically, yes, like you a type of building is, but it's a type of ownership, how you own the condo, because there are some, at least here in Palm Beach County, there are those quadplexes, those, you know, quadplex townhomes. There are some that are here that are considered condos because it's a type of
Right.
ownership. So you don't own the land. Like when those, the easiest way to tell is you don't own the land underneath your quadplex of your one section. That's the biggest way to tell that. Yeah, they are
Right.
different. Those can be considered condos too. So it's a type of ownership you own within the basically the drywall in.
Right.
So you don't own the
Now, do you
actual.
think that condos can be a good purchase or a bad purchase?
I will say they're very. It depends. You have to know what you're getting into. With the whole changes, was it from 20? They changed the law a couple of years ago because of the Surfside collapse of the condos
Yeah,
that
the
happened.
condo complex just
Yeah.
it went down and it
Yep.
raised a bunch of concerns across Florida.
So of course, any disaster that happens, everybody's going to change how things are supposed to be done to make sure it doesn't happen again, and that's exactly what's happening. I think the end. So we're in the middle of April right now. The end of this year, the new regulations that they put into these condos will have to be fully in effect. Which a lot of condos, most condos, kind of already did this, but now they're really getting into it, just to
Right.
get it completed. But yeah, let's go over.
Well, not just like I think it's a good point to make that condos can be a great purchase and they
Mhm.
can also be a bad purchase. So a lot of people like the idea of condominiums because it's usually a lower purchase price. Depends on the HOA or condo fee. But financially, it could be, a little bit less money out of pocket. A lot of people buy them for less maintenance. You don't have to insure the entire building
Yep.
yourself. So insurance is usually cheaper. Property tax is a little cheaper. So you can potentially have a lower mortgage payment with very little to no maintenance, and depending on the condo itself or the facilities or whatever, you might have some great benefits as far as a gym and a pool and a clubhouse and stuff like that.
I do see a lot of people buy them as like secondary homes, their vacation home. They'll come there,
Well,
they'll go
because we
buy
see a
one.
lot in resort areas. So
Yep.
near Disney, we've got a ton. Near the beaches, we've got a ton. So we deal with a lot of condos. Excuse me.
And the loan originator is not good at condos. I mean, it can throw a wrench into the middle. And you could think first thing is that there's two approvals. You have to be approved by the condo itself and then approved for your mortgage. But then the condo building itself has to be approved for the mortgage.
Right.
And that's what we're kind of going into today is like all the different things that we see in these condos. So the main ones is there's a warrantable condo and a non-warrantable condo. And what does that actually mean?
I have no idea.
Of course you don't.
Just
No.
kidding.
That's
Yeah,
why
like
that's why you're
I mean,
laughing.
it comes down to like basically who we're selling the loan to. So Fannie Mae, Freddie Mac, if they follow those guidelines and we have a Fannie or Freddie approved condo, then that would be a warrantable condo. Any condo that cannot be approved by Fannie Freddie would be non-warrantable. And the non-warrantable world is just a little different.
Yeah.
Sometimes not too crazy, but just a little different.
Yeah, there's just certain things that make it non-warrantable. It does usually require a larger down payment than a regular warrantable condo would, but again, usually it's not, some people think, oh, non-warrantable, it's not safe, it's not whatever. That's not necessarily true. It's just how they actually run the condo that Fannie and Freddie they don't approve that that's how they want things ran, so therefore it's non-warrantable. But the biggest one we see is the budget.
That stupid budget.
So the budget on a condo association every year they approve their budget for the next year. And the biggest thing that we see on that makes a condo warrantable or not warrantable is whatever income they're making from the monthly fees that they're collecting. If they're not putting 10% of that to reserves to save, it becomes a non-warrantable condo.
Yeah. So they have to have 10% of that budget in reserves. If that budget's $1 million, that's $100,000 that needs to be in reserves.
Yeah.
So now in that, if you're looking at FHA loans, hard stop, right?
Yep. Has to be
Fannie
exactly,
Freddie,
it has to be, if it's an FHA loan, it has to be to that 10%, no matter
right.
what.
And then Fannie Freddie could potentially play in some gray area. Depending on some of the line items of the budget, they might be able to, take some things out or whatever that help make it hit that 10%. But they'll also, don't they require a reserve study in order to do that?
They don't require
Or
a
is it
reserve
just
study on that, but like you could make the case that, hey, we are only collecting 4 or 5% because we have $1 million sitting in reserves. We don't need to collect any more reserves. So we're lowering
right?
what we're putting in there. You have to have a reserve study done to say, yes, they are right. They don't need to collect. They have enough money. They don't need to collect more money to reserves. So therefore, they would still be considered good to go. FHA will
We've
take that
seen
too.
it too, where the reserve study, they had just paid for a new roof, just paid for like new pavement and some big ticket items like that. That then they gave an approval because that had, like, the reserve study showed that those things had just come out, should be replenished soon. So it was kind of one of those things that ended up helping in one of our cases.
So like
But
we
it's
said,
just getting the documents ahead of time is hard sometimes too.
yeah, I would say so the first big two things that we're talking about which is the budget and insurance on these. If you're a listing agent, or you're a buyer trying to find that, buy a condo, like these are the top two things that you need to get. A listing agent should be getting these and putting it on the MLS or putting it out there that here are the budget, here is the insurance, because it's going to save a lot of time. You don't want to go under contract, get all these things. You might be a week into your contract, so you've already paid for an inspection. Maybe you have ordered the appraisal already. I mean, granted, the appraisal wasn't conducted, you can refund it, but like you already paid, you already had the inspection, so you're out that money. And to find out that, hey, they don't collect enough for reserves.
Right.
Hey, the insurance isn't right, which we'll go over, like, and then have to basically cancel the contract. The seller thinks they got somebody under contract ready to go. The buyer's so happy, and it all blows up because nobody did their due diligence up front to get the right documents with it.
Right. So one thing, and I know that some real estate agents will look at past sales in the community to see what has recently sold. If somebody closed with conventional financing, usually that's a good sign. But make sure. I know it's hard to see, like, well, who was the lender for that? You can't always see that, because if it's nothing but credit unions, it may not be a warrantable condo.
Yeah.
Because sometimes credit unions don't ask all the questions because they're holding on to the mortgage, whatever, versus trying to sell it to Fannie Freddie. So it really just depends. But the first thing you should ask for, the insurance, you can look at that deductible, 5% for a named storm. Anything higher than that, you're going to be in trouble. And then the budget and reserves.
Yeah. Well, on the
So
insurance too, if they had the 5% deductible, then that insurance policy is considered good. But sometimes they have it 10%. Is there anything we can do with that?
ask about a secondary policy.
Yeah, exactly. Yeah, if they had that secondary policy that covers them to basically make that 10% deductible like 5%, then it's good to go.
Bro, a year ago, I didn't even know that was a thing.
Yep, happens all the time. I would say
Never
that
knew that.
when we're asking for these documents, it's like if you ask for the master insurance policy, they're going to give you that master insurance policy. And that insurance company producing that is usually, I have 99% of the time, it's not the secondary policy insurance agent too.
Right.
So if you don't ask for that secondary policy to see if they have it, then you like look at the master and that's all you have. And you never ask for that secondary policy, it could save that loan in there. But
right.
Another thing I ran into, I did one in Jacksonville, and they were actually underinsured. It was an FHA condo. They were underinsured. I think they had like 2 million in reserves, and so FHA says that your insurance policy has to cover everything you have in reserves and 3 months worth of HOA
Expenses?
fees. Yep, or the HOA
Gotcha.
fees that they're
Okay.
have in. and these people had $500,000 of insurance cover. So basically, if they got sued, somebody could sue and take all their money in reserves, and their insurance company would only cover $500,000 back. And so, like, and it was a simple. We went to the condo board and asked them, like, hey, would you up this? And we found out how much it would cost. It cost them $100 more for the year to up their insurance
It's
for
so
the
stupid.
whole to cover it, just to cover themselves correctly.
That's so stupid. Yeah, we've reached out. We've had condos change their insurance policies before. Because we have a pretty good reputation with some insurance companies around us. And the master insurance policy, the master insurance policy was with one of our insurance companies that we work with a lot. So we reached out to them and said, like, hey, the deductible, is too high. Is there any way to change it? We got the association to agree to at least see what it would be. And they ended up upping the insurance. It was not that much more expensive. So I think that sometimes they're trying to save, money, but they don't realize that they're also shooting themselves in the foot.
Yeah.
Because then they're making it a non-warrantable condo. And that's when, you're not going to have somebody with a first-time home buyer program coming in to buy.
Which, if you have less people able to buy it, supply and demand, typical supply and demand. So there's not going to, the value will not increase as much because there's less people that are able to buy it to have that. Now, if you're in a price point where it will, where first-time home buyers could buy it and the condo was approved for it, then of course that's going to naturally let more people come and buy it and raise up the prices for the homeowners.
Because who buys lower priced homes? First-time home buyers and investors.
Yep.
It's typically, the majority there. So if you eliminate one, well, then you just got a bunch of investors that might be paying cash, but, they want to get a deal on it. So now you're bringing down the value of all of your units.
I want to circle back though real quick is we talked about the new law coming into effect. So part of it is I'm not seeing it as often, but why I wanted to bring it up is so everybody had to do if they were, hold on, I have it exactly, if they're over 30 years old, so this is 4 stories or higher, they're over 30 years old, they have to do their what is it, the structure. They're over 30 years old. They have
The
to do
structural integrity, whatever.
And that was the biggest thing why that one collapsed down in Surfside is they kept pushing things off to the side, to the side, to the side, and never taking care of things. Well, the state has come in and said, like, you will have these things done. So it's a 30-year. And so there's a lot of them that had to redo balconies, redo some concrete work in the building because of this. A lot of that, I mean, they've been doing it for about 2.5 years now. A lot of them have completed that. What I'm seeing now, though, is they did assessments to get the money to be able to complete these, but then they also were getting loaned to have the work done. And
so
if they were in like 2023, their budget was, like you said, $1 million. Let's go off that, $1 million. They're putting $100,000 to reserves. Well, they get this new loan that costs them $50,000 a year to pay for it. They are, instead of readjusting their budget to absorb that, what they're doing is taking that $50,000 and now they're only putting 50 to reserves and then 50 to that loan. So they were a warrantable Fannie and Freddie condo, and now they are not because they got this new loan. Instead of readjusting their budget, they just basically took money from what the reserve budget was going to be.
Right. So the new regulations require that COAs hire licensed engineers or licensed architects to carry out MSIs as follows. For every building 3 stories high or higher, an MSI must be conducted by December 31st of the building's 30th year, and then another MSI is required every 10 years following.
So a lot of them have done this already. I think it's 25 years if you're by the coast. So if you're like within like a couple of miles of the coast, you have to do it even earlier. But they are requiring all this. A lot of them already conducted it and have done the work. So it's been done with it. Now they're just trying to offset those costs that we're doing it. So We're seeing that a
Right.
lot lately.
The other law that came in this year was they removed the ability for condo associations to vote or waive to reduce the funding of reserves or use reserves for other purposes. So that's a Florida law that's trying to help get those reserves back up. That should be beneficial over time.
Yeah, once all this really kind of sits there and takes effect, it's going to allow a lot more condos to go Fannie and Freddie. That's what's going to happen.
Right.
They're going to have the reserves. They're going to have to, there's no excuse of like, hey, I have this work to be done. You should have the reserves collected, kind of thing.
Right.
That's it. Well, that's our
All right.
warrantable condos. Let's go to the other side of things, of the non-warrantable.
Non-warrantable condos. Just bring 30% down. And actually, hey, we didn't touch on that. So a lot of times when we're doing a condo purchase, going the normal route, Fannie Mae, Freddie Mac guidelines, if you put less than 25% down, most of the time you have to do a full condo review. Unless you work for a company like the mortgage firm and we've already approved a condo, you might be able to get by with less. But typically you have to do a full condo questionnaire when you're putting 25% lesser down. However, if you're buying it as a primary and you put more than 25% down, you might get approved because we're not asking as many questions.
Yeah, it's a limited
It's
review.
limited review.
So you do get a lot. What they take, the budget's still on there, but there's certain things that we don't have to ask anymore, and therefore makes it where if you weren't putting that money down, if you're putting 20% down, it would be denied Fannie or Freddie, but the 25% down, it could be approved.
Right. So, and one of the main questions that's on a full review that gets asked that tends to make it a non-warrantable condo is the ownership interest.
Yes.
So with Fannie, if 25% of ownership is by one single entity, and that could be one person or one LLC, then you have a non-warrantable condo. Freddie, it's as low as 20% ownership, but one person or one company cannot own more than 20% of the units for Freddie, 25% for Fannie.
Now, what about if there is multiple owners, but they're investment properties? They're not, there's 51% are investment properties. Is that
Oh, why'd you have to say 51%? I need one of them to sell it to somebody that is going to live in it as their primary. Yeah, it's a 50% cutoff. So
when we're doing
if the owner, if 50% of the owners have it as an investment property or second home,
no, just investment. Yeah, they have it as an
or
investment.
just investment.
Yeah.
Then you have a non-warrantable condo. Less than 50% ownership.
Yeah. So if there's more primary and secondary than investment properties, then you're a warrantable condo. If it's the other way around, you're not. Now I have
for
seen
that specific little category.
For that category, I have seen it where there is we were at 51%, but the unit that was being sold that we were doing the loan on was that 1%. So when it technically
so
the
by the
primary
time you would
bought
close, it would change.
Switch over. So it was fine to do it.
That's awesome.
Another non-warrantable would be a recreational lease. So a rec lease occurs when basically the pool, the gym, anything within that condo isn't actually owned and controlled by the condo association.
Gotcha.
I think I've
that makes sense.
I've seen a
rec lease, recreational facilities. However, that sounds stupid.
I don't think I've ever actually seen one do it.
Probably in Miami.
Yeah, I think maybe in Miami there was one that I've seen commercial. That's another thing.
I just blame Miami.
Always blame Miami. So what about commercial? If the commercial space is more than 35%, so if you have a commercial percentage of that building, or the percentage of that building is commercial space, if it's more than 35%, becomes a non-warrantable condo.
What kind of commercial space, are we considering? Like, is this like a restaurant downstairs? Or
anything commercial down
businesses?
There. Yep. So I mean, like there's here in Palm Beach County, there is Abacoa, which is Garden/Jupiter. They tried to act like their own town, but they're not. But there are some condos there that it's a 3 or 4 story building, and the first floor is commercial space.
Gotcha.
So the 2 floors above are the condo itself. I think it's 2 or 3 stories above it are condo itself.
Gotcha.
So that
Okay.
is one way.
All right. What about condo tels? You ever
Ooh,
heard the term condo tels? Now imagine you take the word condominium and hotel and you just push it together. It's a condo tel. Condo tels are hotels that were turned into condos
yep.
or terrible apartment buildings that were then converted and have like oh god, now I'm gonna forget the word. Not like a hostess or whatever. What's the
An
like
on-site
concierge?
manager. Yeah, yeah, yeah.
On-site
Concierge.
manager, yeah, or concierge or something like that. That usually, tells us that it's a condo tel. A lot of condo tels are super small.
Also, it was for the longest time when you looked up the property on the county website, on the property appraiser's website, it told you the type. It would say condo or condo hotel. That's what you went off of. If they however they had their permit for that place.
Right.
I think 2 maybe 3 years ago, Fannie and Freddie changed it where if they act like a condo hotel, which means they act like a resort, they allow
Nightly
Airbnb to be there.
rentals and
Yep.
stuff.
Doesn't have to have an on-site manager. That was the biggest thing, is the on-site manager. That's how you could tell real quickly. But there is one that I do up in Orlando area that one owner owns like 6, 7% of the condos there and has it Airbnb'd out all the time, has a website for it that comes up before the actual condo website is, and Fannie and Freddie have blacklisted it as a condo hotel
Dang.
because of one person. Now, granted, he is also the president of the board, so they're not going to change the rules on him. I mean, the easiest way to change the rules is say, hey, you have to minimum rent it out for 30 days. You're not a condo hotel anymore.
Right.
But if it has resort in the name, not always, it's a red
Well,
flag, doesn't always stop it, but it
we've got
can.
our non-QM lenders that we can send this, these purchases to or refis to or whatever. But we've got a lot of options when it comes to non-mortgageable condos.
Yeah. It
But when
just
it
means
comes down to
you're
condo tells, if it's less than 400 square feet, I think we've got one.
yeah.
There's only one lender that we can send this to.
So it's not that you can't get a mortgage on it. It's always more of a down payment. It's going to be a higher rate. And it just makes it, yeah, you think there's one, maybe two lenders we have. One for sure I know we have. If it's especially if it's
Our partners send me the condo that one of his buyers are interested in. And it's a studio condo tel, which this whole studio side of things is a big they don't like our investors don't love it. Although I'll tell you later who. I don't want to spill the beans or give anybody any other loan officers that are listening out there insight, but we do have an investor that for the right reasons will do a studio condo, by the way.
Thanks. I don't think I've ever ran
Um,
into one.
we didn't realize it was one until the appraisal.
Yeah.
Just the pictures didn't say it. The listing description didn't describe it. It just looked like a condo. And they called it like a one bath, one bed, or one bed, one bath condo. And then come to find out it was a studio, but then the investor was like, put 5% down more and we'll do it. Okay.
It can work out.
But,
Another,
but yeah, so we
another,
just the square footage and purchase price is the other thing.
yeah.
A lot of our non-QM lenders don't want anything less than $100,000 loan amount. So
Yeah.
if the condo's, $105,000, might have an issue.
I also say is that a lot of people want a fixed rate. How the market is right now, a lot of these non-warrantables become an ARM and a variable rate mortgage.
Yeah.
There's a couple that are still fixed, but depending on what it is, some of them become an ARM. And people are like, oh, I don't want an ARM. I want a fixed rate. I want to know exactly what it's going to be for the next whatever years.
That's where you just hopefully we're explaining, and I try to do this with my customers when we bring up ARMs. Is this a bad thing? Well, a 10-1 arm. It means you're fixed for 10 years.
Yep.
Like, and if we're dealing with a condo and somebody's buying it as a second home, investment property, maybe, are you really going to keep it for 10 years? There's just so many times where somebody, does it. But also, if you can't afford to purchase, um, you know, a condo, maybe you just want to pay it off in the first 10 years. Then you don't have to worry about the adjust. However, technically it could adjust down depending on the market. So
Never
it
know.
doesn't always adjust up.
What else do we have on here? Here, we'll knock out these two little ones because mandatory social membership. So almost like a country club where you're mandatory to buy into it. You see these a lot of like the single family homes and country clubs where golf community where they have a mandatory one where you have to pay X amount of dollars a year to actually live there. So that could be one. I've never seen it where they have manufactured homes on the property, but that's another one.
Right. I
Um,
haven't come across either of those when it comes to condos.
yeah, not at all. And then the
A
other one is
mandatory social membership. Get out of here. I don't want to be a part of your club.
maybe you want to golf. You can golf. I don't golf, so
Yeah,
I'll never
well,
do.
leave me alone, but I don't want to join some club in order to go golfing.
Yeah.
And let's be real, they don't want me to join their club either.
All right. And the last one we got on here is open and pending litigation.
That is another big ticket.
This
that we've
came up
dealt
real
with
big,
recently.
2-3 years ago that we started asking
Yeah.
this question. It came out, it actually started coming on the condo questionnaire. This is a big one. And I think the biggest issue is more of, well, what's going to come down to is if the litigation is happening, what is the new owner, which is, got to remember that the mortgage company has a stake into your ownership of that property. What are you going to be responsible for on that litigation? So,
Right.
if they're getting sued, so the biggest thing is, does the insurance cover that litigation? If it's a slip and fall and hey, insurance is taking care of it, they're just going through the procedures and all that, and yeah, the insurance on the condo might go up, but
What
you're
if
not
they
going
were
to.
suing the builder for structural engineering problems?
I don't think I would even want to buy in there even if I could get a mortgage.
We've had that where we had a condo where the issues were somewhat minor. They weren't as bad as that sounds, like structural engineering issues. But they were suing the builder. The builder had been found at fault, was paying for things to be done, and we were able to close because we got all the documentation and everything. So, but we closed with a non-QM loan. So it just depends, man. Condos, like I said from the beginning, they can be great or they can be a pain. And if it's a pain for you to try and buy a condo because of all this, it's a good chance it might be a pain to try and sell it a couple years later.
Yeah.
So
I want to point out one thing that I learned from a real estate attorney. I don't know if I'm allowed to mention her name, so I'm not going to say it yet. But um, there is, she said 90% of the time when agents are filling out the condo rider on the contract, they're not filling it out completely all the time. So that's one big issue we see. But the other one is that people don't realize is that the buyer can cancel that contract at any time until they receive these 6 documents, which is the declaration of the condo, the bylaws, the articles, the rules, the most recent year-end financial information, and the frequently asked questions. Those 6 items. If the buyer does not get once they have all 6, they have 3 days to review it, and then they are allowed to, they can move forward or cancel the contract. But if they don't receive those 3 items or 6 items, they can request or they can cancel the contract at any
really,
time until the day they close. Like, let's say they close today and tomorrow they get all these documents and they're like, oh, I don't like this. Like, I'm going to go back on my thing that I just closed. Like, no, you're not. You can't. You already
right.
closed. But let's just say the morning of closing, They get all those documents and they're like, hey, this is the first time I got it today. First time I got on all these. I don't like X, Y, and Z in it. They can cancel it.
So it's from when they receive it.
When they receive it, when the buyer receives it. She was very adamant on saying that. It's when the buyer receives it, not when the buyer's agent receives it. It's when that buyer actually has it in hand.
Well, if I
They
was a
have 3
realtor,
days.
I would just hold on to this until the last day, make sure everything's good to go. And then if there's some reason we want to back out, I'd just send this over. Hey, time to cancel. Here you go. I got you out.
She says that it happens a lot. It's like when somebody, like a buyer comes in and, they're disgruntled with the seller and whatever, they want to cancel the contract and they review it. The first thing that any attorney looks at is, did you get these 6 items? Not one,
Gotcha.
not 2, all 6 of them. And if you didn't, they're going to be like, you can cancel right now and there's nothing the seller can do about it. So listing agents, make sure you get all these documents and make sure the buyer gets it right away. Because worst thing you want to do is be a couple days before closing and did all this work to find out that, hey, sorry, buyer canceled and nothing we can do.
Right. Send the earnest money back.
Yep.
Hey.
Yeah, I was like, ooh, I did not know that. I didn't know it's, I knew the guy to get these documents, but if they don't receive them, they can get out of there. So condos.
Is that the same for an HOA?
Not that I know of, no, because this is all.
It's just condo.
Yeah. I think it's how it's written on the condo. Yeah. Looking at her paperwork from she taught a class on it, and that's what I was looking over just to see if that was a big thing. Everything else she was talking about, I knew about. I didn't know about that exactly.
I'm looking at a condo writer right now. I don't know. I mean, I guess I haven't really had a buyer that wanted to try and back out at the very last minute, and we had to go to some lawyer trick.
She said that when this happens, when people come, anytime that you have a disgruntled person, they're going to hire an attorney, and the first thing the attorney's going to ask, is this a condo? Yes. Did you receive these documents? If they say no, they'll be like, here you go. That's how you can get out of it right now.
So here it is. Paragraph 5. Non-developer disclosure acknowledges.
Yeah, so its buyer has 3-day recession period after the contract execution and receipt of all the condo documents. So once they execute the contract and they receive all 6 of them, that they have a
copy of the Declaration of Condominium, Articles of Incorporation of the Association, bylaws and rules of the association, copy of the most recent year-end financial information, and frequently asked questions and answers. Document more than 3 days, excluding Saturdays, Sundays, and legal holidays prior to execution of this contract.
That's their out.
Snap!
Most people thought like, oh, that means once I have 3 days to give it to them. No, they have 3 days that once you give it to them, they can leave when they get it.
Gotcha. Good to know. Look at me learning something on our podcast today.
That's why you're Robin today.
I said I'd be Robin today.
I had to do it. I had to bring it back in, but
I have a team that helps me with condos.
I mean, we do. I mean, most good loan officers.
I send it to our. We've got a group of underwriters, so.
Yeah.
Oh, Steve, you want to see something awesome?
Your tattoo?
Stevie Sleevey! I just wanted to be like Steven, so I got tatted up this weekend. And I don't, just kidding, everybody. It's just a fun little sleeve. I don't have tattoos. I'm not cool like Steven.
Stevie Sleevey. I like that though.
It's my Stevie Sleevey.
I didn't really call that, or that's what you just call it.
Well, that it's now been broadcasted on the podcast that's heard worldwide. So it's going to be called the Stevie Sleevey.
The Stevie Sleevey.
Oh man. All right. Anything else?
No, I think we covered condos. A wonderful
that
world
wraps it up for condos. To everybody listening, thank you for joining us. This is the Brutally Honest Loan Officer podcast. I'm Derick Brown, and Batman today was Stephen Brock. Thank you for joining us. Follow us, like us, subscribe us, and we'll see you next week.
See you, everybody.